attending the financial literacy program here today, and just a little bit about WeSERVE CDC. It has partnered with Will and Way CEC to bring financial literacy to our WeSERVE Cares program. And the financial literacy program will be held on the second Saturday each and every month, 10 a.m. Eastern Standard Time. That's the local time. And so WeSERVE Cares, they offer financial education to support individuals seeking to build their financial resilience. And so the classes will cover the following topics. November, which was last month, it was growth through compound interest. This month of December, we will be talking about life insurance options and variations. And then the next month, next year, 2024, we will be covering home buyer benefits and financing options. So as of today, on the second Saturday of this month of December, we will be covering life insurance options and variations. All right. And so once again, that's what we'll be covering today. Life insurance is very important. That's one of the least talked about components for families, that covers families, protects families. And we've discussed before about life insurance, the different kinds of life insurance, but this kind of life insurance class session is going to dive a little bit deeper, giving you the components, the science of how life insurance works, right? And just an introduction. I am your facilitator, yours truly, Readiness Graham III, a financial literacy facilitator. And a little bit about myself. I am a business entrepreneur in several fields. I am a senior field manager in the financial service industry, 8 years of experience as a financial strategist. I am a multi-state license in several states here in the country. I cover healthcare insurance, life insurance, including retirement accounts as well, IRAs, 403Bs, 457Bs, and other FICA alternative plans as well. And so today we're going to cover the 4 basic types of life insurance. This is our table of contents, our schedule for the day. All right. We're going to talk about the final expense policy. We're going to talk about the term life insurance, whole life insurance, and IUL. And a little bit about the final expense. I've discussed this before, but I love to talk about it again. This is my passion in what I do. Final expense is covering if you were to pass away and we have to pay for your funeral. That is your last spending cost, at the end of life. You have term life insurance. Term life insurance covers you for a certain extent of time. You have whole life insurance. Whole life insurance is a permanent policy, as well as IUL life insurance. That is an index universal life plan, life solution plans. And so if you can review Life Insurance 101 for in-depth review for all your different types, we have all that information there. So you will feel free, more than welcome to go back to Life Insurance 101 and just give you some rundowns on those 4. Those are the final expense, the term life insurance, whole life, and the IUL life insurance policy as well. Voluntary life insurance, right? That kind of life insurance is a very, very good coverage. I will say this: any coverage that's considered life insurance is a very good coverage to have. So you have life insurance, voluntary life insurance versus basic life insurance. You have voluntary life insurance, and the benefits of the voluntary life insurance is when you're employed and it's a part of the employment benefits package. So as long as you're employed with whoever you're employed with, whoever you're hired with, you're going to have that coverage for that time. Okay. It's less expensive than purchasing independently. It also lasts only as long as you are employed. That's another key benefit. That's the most important benefit, or something to make aware of, is that as long as you're employed with your employer, you will be covered. But if you decide to either you retire, resign, or change careers, you're no longer employed. You're no longer employed. You're no longer covered. Okay. At least a minimum guaranteed issued amount with no medical exam. So there's give and takes with that. You know, you will have the least minimum guaranteed coverage, which is great, it's inexpensive, and it does not require a medical exam. You don't have to see a nurse. The nurse doesn't have to come out and have to do labs and lab work, draw blood, and all that stuff like that. So that's awesome too. Convertibility may be limited and at much higher rate if allowed at all. So it depends. If you consult with your HR, human resources, they'll let you know the type of insurance. They'll let you know if it's convertible, which means you can take this as your own, your very own coverage, convert that into your very own coverage, and take it with you if you decide to leave. Or if they're unable to do it, they'll let you know whether if that's that kind of life insurance that works with you. So it just depends with the company. The basic life insurance is where it is purchased privately by and for an individual. So you have your very own independent coverage that is yours to have, yours to be covered. It is more customizable than voluntary life policy. So you have more control of your policy. You can design it. You can be able to set it up the way you want. You can determine the death benefit coverage, how much you want, more or less, or keep it the same, however way you want to do that. It lasts a predetermined number of years of your life. So permanent coverage, which is considered basic life insurance, it covers you and it's enforced for the duration of your life, which is a great thing. Guaranteed issue, not necessarily available, must meet eligibility requirements, varies by insurer. So according to the MIB, that's the Medical Information Bureau, they will be the ones that will determine if you're healthy enough to be able to get the coverage. Now, there are some people who will qualify, and there are some people who may not qualify. It's all contingent upon your health and how healthy you are. So if you have a good, reasonable portion of health, no history of cancer, no history of strokes, no history of heart attacks, you know, even family history as well. If you have none of those things, then that will just increase the chances of you getting the coverage that you're looking for. Also, convertibility from term to whole life is usually available as well. So we'll touch bases a little bit more on the convertibility and how that works as well. All right. So under the life insurance options and variations, there's two types of life insurance policies. You have your term life versus your permanent life. And the most commonly asked question is, okay, which one is better? You know, which insurance policy is better? Is one better than the other? Overall, as long as you have coverage, that's what matters. It's better to have something coverage than not have coverage. It reads there, it says, no matter whether you choose term life insurance or permanent life insurance, they are both worthwhile coverages. Life insurance coverage is better than no coverage at all, just like what I mentioned. In the end, it comes down to choosing the type of coverage that is most appropriate for you and your family. Term life insurance may be a good option for those looking for temporary coverage, while permanent life insurance could be the perfect choice for those who need long-term protection. Ultimately, it is important to research and understand the differences between both types of coverage so you can make an informed decision. So you have some people that say, you know what, I don't have to have this coverage for life. I may have some different plans in the future. So they will go with term. That's fine. Coverage is coverage. But then you may have those who say, hey, I want to have long coverage for life for a long period of time. Then I believe that permanent will definitely work best for you as well. All right. Term life insurance benefits. How does term life insurance benefits work? So the first bullet point, a limited period of coverage is provided to you. So you have a minimum of 10 years, you have 15 years, you have 20 years, you have a maximum of 30 years. You can select from those different options based on how long you want to be covered. So if you elect 10 years, for that 10-year time frame, you will be covered for that amount. It's 100,000, 200,000, however much you feel is covering you based upon your insurability needs. Then you have death benefit protection. which means that the beneficiary is covered in the event of death of the insured. God forbid it happens, but such is life. If you were to pass away, something happens, you have the death benefit in place that will be able to cover you and be able to give the funds as a gift to your beneficiaries, right? Then you have living benefit protection, okay, that is covering the cancer, it covers stroke, it covers heart attack, etc., right? So living benefits is a very good benefit. So, for example, you have $100,000 worth of coverage, right? And God forbid you have a stroke, but that's going to cause for you to get physical therapy or a surgical procedure, right? They can accelerate up to 100K or plus to cover the medical expenses. And what do you have to come out of your pocket? You don't have to come out of your pocket for nothing. You don't have to pay out of pocket because you have that living benefit. So that's a really huge benefit of having term life insurance. Then you also have the conversion privilege where you can convert your term coverage to permanent coverage. So it gives you the ability, say you enjoy the coverage, you like what you have $200,000, you realize, hey, I'm at the 8th year of my policy, I have a 10-year term, and I'm 8 years in, I got 2 more years left to have this $200,000 worth of coverage. So with that, you can be able to convert and say, I want to turn this from term to permanent. That means I want to have it for life. I don't want to have to keep renewing it. I don't have to keep paying for the hiking cost of insurance that's going to continue to go up every time you renew. So that's the benefit of converting. You can convert your term to permanent. But the goal is for you to get approved for life insurance, whether if it's term, whether if it's permanent. To get approved, what you're in, you're good to go. So that's the benefit of that as well. Permanent life insurance benefits. So a permanent plan of coverage is provided to you. And so that means it covers you for the duration of your entire life, all the way to maturity. So as long as you're living, as long as you're paying on the cost of insurance, the policy will remain in force. Then you have the death benefit protection. Same thing like the term, the death benefit protection is reserved for the beneficiaries. Not a matter of if you pass away, but when you pass away, right? We're human beings and we we have finite lives, right? There's going to come a time when we're not going to be here any longer, but the death benefit will go straight directly to your primary beneficiary and your contingent beneficiary. The contingent beneficiary says that in case anything happens to you as the insured and the primary beneficiary, the contingent will be the next person in line to get the coverage, the actual death benefit gift for that. Same thing, living benefit protection that covers cancer, stroke, heart attack, any of those things were to occur. There's a longer list of other ailments as well that the living benefit protection covers as well. It covers that, and you don't have to come out of pocket for the medical expense. Perhaps you needed to get the coverage that you need based on that living benefit policy. All right. Then the last one is that it builds cash value. Okay, the cash value, that's a huge component there. This is something that term life insurance do not provide, and it builds cash value with tax-free withdrawal income. So in any event you're paying every month, for example, you're paying $200 every month, $150 of that 200 is going to the cash value. So it's like a pot, right? $150 is going into that pot, into the cash value. The other $50 is paying for the cost of insurance. So every month, as you're putting in and paying into your permanent policy, you're compounding, you're growing your accumulated value in your cash value. That allows for you to get, it's called the return on premium. You can get money back out of your permanent policy, and it's tax-free. So that's just an additional edge that the permanent life insurance policy has over the term. Term doesn't provide that, but remember, because you have the conversion privilege, you can convert from term to permanent. That will give you the chance to invest into a cash value plan as well. All right. And once again, it's tax-free. Do not pay a dime to Uncle Sam in your tax-free cash value. All right, living benefits. What are living benefits? Okay, I just want to just retouch on living benefits. Just the definition of that. How does that really work? So living benefits are benefits for the living. So you have $100,000 worth of coverage. That $100,000 is not only a death benefit, because remember, death benefit is when you die, when you pass away, go see beneficiary. But living benefit is say, okay, you fell, you broke your arm, you're unable to perform 2 out of the 6 living daily activities, right? And so the benefit of that is that they can accelerate a portion of that 100,000 that's supposed to be for your death benefit to take care of you while you're alive. That's the benefit of that. So it's living benefits for the living, for those who are living. What life insurance can do more than pay a death benefit. With powerful riders, you can make or be able to accelerate the death benefit due to a qualifying illness or injury and potentially provide a guaranteed source of retirement income if you were to live too long. So that's a wonderful thing. Those 3 puzzle pieces you see there, you die too soon, you have a death benefit to take care of your beneficiaries. If you become ill while you're living, you get access to your death benefit to accelerate the funds to take care of your medical costs. If you live too long, okay, mind you, rather than you outliving your money actually outlives you because you have a cash value that will be able to take care of you and ensure that you're alive. So the accelerated benefit riders are optional. It's no additional cost. That's a wonderful thing. It also could allow you to access all or part of the death benefit while you are living if you experience a qualifying terminal, chronic, or critical illness or critical injury. You can use the benefit for any purpose with the exception that ABRs, which accelerated benefit rider proceeds, are for chronic illnesses. So the funds that are that check, when they write that check out to you, and for example, they say you qualify for $45,000 that's being accelerated to you out of your death benefit, that $45,000, that is your money. So if you had a broken leg and you can't walk and you're unable to dress yourself, right, and they give you that 45,000 to take care of your medical costs, that 45,000, if you want to go on vacation with your broken leg and unable to dress yourself, you can take that 45,000 to do that. So it's yours to be used for any intended purposes. That's how that works with the accelerated benefit rider for living benefits. So primarily, you want to make sure you use that money for your medical costs. That's for sure. But it's your money. That's the benefit of that as well. All right, the death benefit, right? The death benefit. The death benefit is the money your beneficiaries get from your life insurance company. All right, it's usually tax-free. It can be paid out all at once or over time, but you should ask a tax professional based on it being tax-free when it comes time to file your taxes. But consider this death benefit a gift. It is a gift. It is a legacy that you are leaving for your beneficiaries. This is one of the most important components to truly consider, that the death benefit is the money that you're reserving for your family. It will, I mean, it would be such a terrible conscience to have on your shoulders when you don't have anything in place and save for your family. When you leave this earth and your family don't know what to do with your remains, it's like, what are we going to do with your remains? And you don't have any death benefit, any policy in place for your family. And I always tell my clients all the time, they're mourning, they're in grief. They should be grieving for one situation for you. That's you, of course, because you passed on. But they should not have to suffer double the grief. Double the grief says that I have to, you know, cry because you're gone. Secondly, I don't have enough money to be able to memorialize you, whether if it's cremation or burial, right? So leaving your family with nothing is truly a detriment that you don't want to leave behind. So that's why it's called death benefit. They want to be able to have the funds and just do it seamlessly to take care of your funeral costs or whichever way they want to memorialize you. So that's just the the importance of the death benefit and how that works as well. The death benefit you choose when you buy your policy goes to your beneficiaries, like I was mentioning before. Your loved ones will get a $1 million lump sum if you buy a $1 million life insurance policy. If you apply for coverage at 10 to 15 times your annual income, it allows you to do that. That's something that's highly recommended as well, because when you're gone and your income stops, your funds stop, your income stops, right? But that death benefit is able to overshadow the death benefit, is able to overshadow the bills, overshadow the debt, because it is 10 to 15 times your annual salary. And going back to the second bullet point on your right hand side, your loved ones will get a $1 billion lump sum policy. Now, the way that works is if you elect a 1 million, then your beneficiaries will be entitled to that 1 million. If your death benefit is 800,000, your beneficiary will be entitled to 800,000. If it's 500,000, 400,000, 200,000, whichever way you set it up regarding that death benefit, in that situation, you will be able to set that up, and your beneficiary will get that amount whichever way you set it up for. All right. Beneficiaries. Who are the beneficiaries? What is beneficiaries? And these are just simple definitions in terms to the purpose of a beneficiary. Okay. The beneficiary is the person or entity that you legally designate to receive the benefits from your financial products. All right. For life insurance coverage, that is the death benefit your policy will pay if you die. And we're going to change that word, not if, but when, because it's going to happen. Death is inevitable. For retirement or investment accounts, that is the balance of your assets in those accounts. So whatever you have in your account, like I mentioned before, however much is saved, however much is saved as a death benefit, right? That amount will go to your beneficiaries. Your beneficiaries will reap the benefits of that. Regarding the life insurance coverage, your death benefit will pay. It just, once again, it's a no-brainer. It's like, it's weight off of the shoulders of the beneficiary. They don't have to freak out. They don't have to, get nervous and be like, how am I going to take care of you? But your beneficiaries, once again, are your loved ones, your closest loved ones, and they're the ones that's going to benefit from the death benefit as well. All right. Cash value. All right. Here's that. This is the beautiful part of the cash value. The cash value is something that it's a component that is associated with permanent life insurance plans, such as whole life plan, such as the IUL. Okay, so whole life covers you for life. So does the cash value in the IUL. All right. With that is guaranteed death benefit to beneficiaries. There's tax advantages in the cash value. It's extreme flexibility. There's cash value that grows tax deferred. It's very low interest and tax-free loan options. There's access to cash value during your lifetime, even while you're alive. And you can use the cash value to pay your premiums as well. So there's a lot of great benefits having the cash value for, like I said, for whatever intended purposes. Now, here's a good deal here with cash value. If you pull the money out, let's say, okay, you have 100,000 as your death benefit, that's your umbrella, right? That's making sure that you're covered. So in case of death or living benefit, that's covered through there. Cash value says, okay, you have 75,000 in your cash value, right? And you need half of that. You need half of that money to take care of, let's just say 60,000. You need 30,000 out of your cash value, right? That 30,000 can be used for whatever intended purposes. Now, another question I always get is, if I get 30,000 out, which way, how can I do it? What is the requirements? What is the recommendations of getting access to the cash value? So my recommendation, I always recommend my clients to get it out as a loan, not as a withdrawal. Take it out as a loan, not as a withdrawal. Because if you take out the cash from by way of a withdrawal, right, what happens is you will be taxed by the IRS, and they will tax you on your gains rather than your principal. Gains is your interest that is being added to your principal dollars that are in your cash value. So you ask for 30,000, you take out a withdrawal, you're not going to get the actual 30,000 because Uncle Sam's going to tax the gains. Realistic case scenario, you end up with 26,000, 27,000. It's all based upon, contingent upon your tax rate. So I always recommend taking it out as a loan. Why take it out as a loan, but I have to pay that money back if I take it out as a loan? Well, this is how this works. This is the magic of having a permanent policy, a cash value. So in a permanent policy, you take it out as a loan for 30,000. You get the full value of the $30,000, right? And with that, okay, the loan, you know how that goes. The old saying goes is that if you take out 30,000 or you take it out as a loan, guess what you got to do with that money? You got to pay it back. That's the rules at your typical banks, right? What if you fall on hard times and you are unable to pay your $30,000 loan back to your life insurance policy? Am I penalized? No. Do I get penalized by the company or by the IRS? No, you're not penalized by that, right? What happens? Do I lose the policy? Is the policy terminated because I took out 30,000 out of the cash value? Nope. You can still get to keep that. So what the company will do is they will subtract. Remember, you have $100,000 that is your death benefit and your living benefit. They will subtract that 30,000 from that 100,000 to pay the companies back, to pay themselves back. And guess what? The rest of the 30,000 you have, because mind you, you had 60,000 in your cash value, so you're down to 30,000. So the remaining 30,000 still remains in your account. You get to rebuild in your cash value because you have some funds left and your policy is still in force. That is the magic of having a cash value and having a permanent policy because of the cash value. And once again, when you're filling out the form or you're applying for that loan out of your cash value, when you're applying for that loan, you don't have to fill out reasons for it, or you don't have to give further proof and explanation as to why you're applying for this loan, why am I in need of this money or whatsoever. None of that. You just say, hey, I need a loan. How much do you have? I have 60,000. Okay, I need 50% of the value of my cash value. Okay, no problem. Out of that 60, we'll give you 30,000. 30,000, do whatever you like. Go on vacation, start a business, down payment on a car, get caught up on your bills. Whatever the case is, that is the beauty of the cash value and how the cash value works. That's the wonderful thing there. It's extremely flexible, right? It's very flexible. So however much you're putting in $200 a month. If you need to increase your amount and say, hey, I want to build up my cash value more, I want to get more money in my cash value, you can do that as well. If you need to decrease it, you can decrease it as well. The good thing is that when you enroll into a life insurance plan and you say, hey, I wanted that 200, you're not stuck at that 200 forever. And that applies specifically to the IUL. So that's the benefit of that. Once again, tax advantages as well. And then, of course, you can consult with your tax professional based on your tax rates there. But once again, the cash value is a beautiful thing. I have a permanent policy myself, and seeing my cash value grow is a wonderful thing. Emergencies come up. If I need it for whatever purposes, for anything, that's what the cash value is there for. Here's some of the factors affecting life insurance premiums and cost. Okay. Now, going back to what I was mentioning before, okay, getting a life insurance policy, when you're getting a life insurance policy, you're applying for it, right? They don't automatically start taking money from you. or you're making your premium payments, you're not making payments right away. It takes up between 2 to maybe 2.5, possibly 3 weeks for them to review the application. The reason being is because the MIB, the Medical Information Bureau, they have to take a look at your health history. They got to make sure, are you good, and make sure, your health is in order. All right. And so they will determine the COI, which is the cost of insurance. And so typically, if you're in good health, cost of insurance is low, and you're young, because cost of insurance is all contingent upon your age. So if you're young and you're in good health, cost of insurance is a lot lower. But here are 7 of the factors that causes the cost of insurance to go up. Age, as you can see right there, I'm just talking about it. Age. If the older you are, the longer you wait to get life insurance coverage, the higher the cost of insurance is going to be. I highly recommend, and I always encourage younger people, while you're young, get a life insurance policy plan right now. They said, when should I start? Yesterday. Getting a life insurance policy while you're young, because this is what happens. You're 20 years old and your life insurance policy costs $22 a month. Well, for the rest of your life, at 20 years old, it's going to be $22 for the rest of your life. In your 30s, $22. In your 40s and 50s, $22. In your 60s, $22. It's going to be the same amount. So while all your other friends are procrastinating, they're waiting to figure, like, hey, I'll get the coverage later on. I don't need it now. And they realize, okay, I am 40 years old or 50 years old, and hey, I'm going to these different life insurance companies and I'm applying for it, and they're telling me my cost is $280. My cost is $300, and this and the third. Well, because you waited so long, when your age increased, so does the cost of insurance. Then they go back and ask you, they say, hey, well, so how much are you paying every single month on life insurance? Oh, I'm paying $22. $22? How does that work? How did you get it for so low? Well, because I got it when I was younger, right? When you get it when you're younger, once again, the cost of insurance is a lot lower. Gender also plays a role in that as well, typically for male and female. Males, the cost of insurance for males is typically higher, slightly higher than females, because men have a short time span of living than the women. And that's just how that works as well. Health, okay, any health history, any cancer, stroke, heart attack, any diseases, whichever the case may be, when you're putting that on the application, that could also affect the cost in terms of how much you're paying, on your premiums, right? So your health plays a big role in that as well. Tobacco consumption. I always ask, do you smoke? Do you drink? Are you a smoker? If you are a chimney smoker, right? Okay, it's not going to say, hey, you're going to be denied coverage. There's a possibility that you could be. And I say could because it's contingent. But they say, okay, you smoke too much, but we're going to give you the coverage, but your cost of insurance is going to be high. That's the cause of it, because of you smoking the tobacco consumption, smoking cigarettes. Same way with you drinking, things of that nature. Driving records. They want to know, how's your driving record? Do you have any DUIs, right? Do you have driving under the influence, any speeding tickets, any of those situations? Even if your occupation, if you're a pilot, right? If you flew planes or if you do construction, is based also on your occupation. If you have dangerous jobs, that also can hike up and have an effect on the cost of insurance. Primarily your driving record. If you have a terrible driving record, then you're looking at a much higher cost. They see how many tickets you have and all these things like that, getting pulled over quite often and drinking and driving, and I may have to go to jail, and you don't want to have that. The goal is to have a clean driving record. That's the main thing as well. Family medical history. They always ask, typically I will ask my clients, when it comes to your family history, is your father still living? Is your mother still living? Or, perhaps if they pass away, what was the cause of death? It could be cancer, it could be stroke, it could be heart attack, it could be maybe some ailments, diseases, whatever the case may be, it's contingent upon your health history, your grandparents, and then your parents to the grandparents and your greats. It goes back to that medical history. And that also what determines and have an effect on the COI, which is the cost of insurance. Lifestyle. People with dangerous jobs or risky hobbies, like I mentioned before, have higher premium costs. For example, auto car in racing or skydiving or construction. You have professional scuba divers or people who jump out of planes, professional skydivers, pilots. Those are high risk jobs. Those high risk jobs are risky. It's dangerous. So that can also have an effect also on the cost of insurance as well. And so those are some of the factors that is affecting life insurance premium and cost as well. All right. So just a brief recap. We just want to recap briefly. Today we discussed the term versus the perm life insurance. So now you have some knowledge on the difference between term and perm. Remember, term is for a certain set amount of time. It covers you for a certain amount of time, right? If it's for 5 years, 10 years, 15 years, 20 years, all the way up to 30 years, it covers you for that standard amount of time. Permanent life insurance is what covers you for a lifetime, covers you for the rest of your life. Okay, that's going to remain in force for that time being. We also discussed living benefits. If you die too soon, you have a death benefit of however much you have coverage for. We call it your umbrella. It will take care of your funeral costs. And of course, the funds will go to your beneficiaries, whoever you appoint as your beneficiary, right? If you become ill, if you become sick, you have that death benefit that also acts as a living benefit. Because while you're alive, they have that benefit that will take care of you there. All right. Death benefit, of course, as we already know what death benefit, how that works. If you were to pass away, when you pass away, the death benefit, of course, goes to your beneficiaries. Your beneficiaries are the people that inherit the death benefit that has been in place. That's on the policy that will take care of your family to make sure that they're good. Lastly, is the cash value. Cash value, once again, you have access to your cash value that only applies to permanent life insurance policies. I want to make clear that term policies do not accumulate cash value. They do not accumulate cash value. Cash value accumulates for permanent life insurance policies. So that's something I want to make clear because I want you all to play this back. Term, you do not get premiums back. You do not get money back from term, right? Let's say you had a policy for 20 years in the term. Yeah, you say, hey, I've been paying $24,000 on this policy. I am entitled to have that $24,000 back in my term policy. You will not get that money back. Now in the perm, you have $24,000 in. Yes, you can get that 24,000 and use that because you're able to accumulate that in your cash value. So that's how that works there. Plus the factors that affect the premium cost. That was the last one that we did cover is your health. Remember what you do, your occupation, your age plays a factor in that, family history, that plays a big factor in that as well. So those different components are what, that has an effect on your premium cost as well. So that is my recap. And that is all I got for today for you all. I believe this was helpful. And if you have any questions, feel free to contact us. My information is there. Our diagram at willandwaycec.org. If you want to set an appointment consultation with us, you can feel free to go to the calendly.com/Readiness G03. Be glad to sit with you and consult and see what your insurable needs are. You'll also feel free to visit the website, Will and Way CEC website. That's Will and Way CEC.org as well. All right. So we love to hear from you. Feel free to take a survey. Let us know what you would like to hear more about. If you have any further questions or some feedback, we love to hear your compliments, whatever it is. Send that in to us. We'll be glad to answer them as well. But that is all I got. Thank you, Mr. McCowan, for having me a part of the financial literacy program. And I wish you all the very best. All right, you all You have a wonderful, fantastic day. All right. Later.